Yeah, I mean, we're always pretty focused, as you know, on the long side. So today we like necessity-based, grocery-anchored shopping centers. Whether it's good times, bad times, people need to eat.
Yep.
So those, not fashion, but the grocery anchor is key. And then you look at the ancillary tenants. I mean, you can't get your shoes fixed online. You can't get your nails done online. You can't get your, teeth cleaned online. So the ancillary tenants are not susceptible to e-commerce. That's one sector. We like seniors housing, where you have demographics in your favor. You've had a significant shortage of supply. As we touched on the precursor to our chat today, none of us are getting any younger. And this is a sector that's done really well coming out of some of the challenges of the pandemic with occupancy going up. We like data centers. I mean, this is something, your listeners can't do in the property market. You wake up every morning and you read the Wall Street Journal or the Globe and Mail, and there's some institution that says, I got to be in data centers.
Obviously, there's so much talk about what's going on in the market, but I wanted to talk also, one of the most popular markets is to talk about real estate. That's why I'm so pleased to have Jeff Olin on with me, of course, Vision Capital, who does tons of business on both sides of the border, but also can play the market to go down. And I'll tell you, from our audience's point of view, he's made him a lot of money in the past when a sector goes sour. So I thought, perfect guy to get his perspective on. Jeff, thank you for taking the time.
Thanks for having me. Good morning to you.
Now, let's start with, again, how can we not? The impact of the Trump tariffs, the uncertainty that that's created, impact on business on both sides of the border.
Yeah, it's obviously the elephant in the room. And I think even bigger picture, respectfully, the orange-haired guy south of the border is even a bigger issue. That's just one of many things. And frankly, I think every asset class globally needs an additional risk premium associated with them for the foreseeable future during this presidency, because there's no telling what's going to happen tomorrow. To your heart of your question, tariffs, the elephant in the room in Canada and elsewhere. The advantage we have at Vision is we're not passive investors, we're active investors, and we can focus on those sectors. And our base case at Vision today is a recession. So we're not here to be bulls for real estate. Our base case right now is a recession. As you know, we've been in a per capita recession in Canada for years, but bigger picture, our base case is a recession. So we're focusing on themes that don't have exposure to either recession or tariffs, and we can do that in public markets. And similarly, we're also looking at sectors, as you alluded to, that are going to be troubled by recession and tariffs, and we have the advantage of being short to benefit from price declines in the securities.
Yeah, and just a reminder that Vision Capital, makes their real estate investments within the stock markets, and of course that advantage is instant liquidity. That would be one thing, but you can also then evaluate whether, hey, this thing's way overvalued or this thing's way undervalued, and that's why you've managed to post gains every single year in operation. And I just think that's an important thing for people to understand. I think it's an important advantage for you guys that's available to you.
Yeah, that is certainly an advantage of being in public markets. We can buy, our mantra is we buy real estate cheaper in the stock market than one can in the property market. We get professional management, we get corporate governance, we get geographic diversification, we get property type diversification. Nobody calls us in the middle of the night to fix the heater, and we have liquidity, so we can be nimble. And as we said, if the fundamentals are negative or deteriorating, or valuations are too high, we can take advantage of that by being short.
What do you like right now? I mean, first of all, let's start either geographically or sector or whatever. I mean, what occurs to you, what you're sort of saying, hey, there's some opportunity here that our team is looking at.
Yeah, I mean, we're always pretty focused, as you know, on the long side. So today we like necessity-based, grocery-anchored shopping centers. Whether it's good times, bad times, people need to eat.
Yep.
So those, not fashion, but the grocery anchor is key. And then you look at the ancillary tenants. I mean, you can't get your shoes fixed online. You can't get your nails done online. You can't get your, teeth cleaned online. So the ancillary tenants are not susceptible to e-commerce. That's one sector. We like seniors housing, where you have demographics in your favor. You've had a significant shortage of supply. As we touched on the precursor to our chat today, none of us are getting any younger. And this is a sector that's done really well coming out of some of the challenges of the pandemic with occupancy going up. We like data centers. I mean, this is something, your listeners can't do in the property market. You wake up every morning and you read the Wall Street Journal or the Globe and Mail, and there's some institution that says, I got to be in data centers. We say, how? How exactly are you going to do that?
Mhm.
You don't have any development capability. You don't have any global technology relationships. This is a sector with explosive growth, and there's some really well-managed public entities that, in light of what's happened in global macro, you can now buy them at compelling values. We like manufactured housing communities. This is affordable housing. This sector has never had, ever, 12 months of declining net operating income, including the Great Recession. So those are some of the sectors that we like and we have exposure to today at Vision.
By the way, is there a difference for you looking at the U.S. markets versus the Canadian markets? Because that's where you're hunting, forgive that expression.
Absolutely. So we say that our blood at Vision is supply and demand by property type, by geographic region. Some of the cliches you hear in real estate, we believe, are nonsense. Location, location, location. You could have had, as you've alluded to, office buildings in Calgary, Alberta, Canada, or San Francisco, California, the best located buildings. How's that going for you? Not so good. Interest rates. Interest rates are important. They're always trumped by supply and demand. So today, for example, we continue to like the industrial sector, even though it's susceptible to tariffs, but we're doing it on a paired long-short basis. So we're more cautious than the U.S., which has had a lot of new supply, and Canada vacancy rates are lower. And we've shifted away from the big box, major regional distribution centers, which all the new supply has been that big box, that, so-called obsolete real estate, in inner core Vancouver or Toronto, that 20-foot clear height ceiling, which nobody builds, that's getting the highest rent because you can't replace it. And that's driving last mile e-commerce distribution, and we're avoiding the big regional distribution centers. So we shifted more out of the U.S., more to small bay, away from large bay. We like seniors housing more in Canada, just because there's been less supply. Occupancy has recovered more quickly. We like manufactured housing everywhere, but you can't buy it in Canada. So we like that in the United States. And we like grocery anchored shopping centers, both sides of the border. But Canada is much more compelling because there's been much less supply, and they're just very high quality enterprises in Canada. So it gives you some flavor.
Yeah, I'll ask specifics in a moment, but I just want to get your take on just the valuations. You get the macro situation and the whole market comes down at one point. Obviously that must create some opportunities, things you've had your eye on. You go, okay, well, that's a better deal now.
Indeed. So, a couple of frames on that. Why do if we had the opportunity to deliver, not losing money for our clients, if you will,
Yeah.
is that, when you're buying at a discount, one of my former clients used to say, I think I've shared this with you in the past, it's hard to fall out of bed when you're sleeping on the floor. So if you're
Yeah.
buying at a 30% discount and now market's correct, okay, now it's a 20% discount. But the bigger picture is the difference between real estate and any other asset class is the size of the property market dwarfs the size of the public market. And yet there is an arbitrage between the two. We say we'd rather not compete with Blackstone. We'd rather sell to Blackstone, which we've done on 4 occasions in the last 5 years. So you see, I think the latest data from an independent source, Preqin, is $600 billion of dry powder sitting with the Blackstones and Brookfields, private equity funds fully funded, sitting in cash, looking to buy real estate properties. As long as there's that demand for real estate properties, our approach of buying at a discount looks kind of interesting. In fact, there was an article in the paper a couple of days ago. Brookfield's raised the largest fund ever in terms of buying distressed properties, and so it is an interesting time in terms of valuations coming down and making that opportunity on the upside more compelling.
What's fascinating also, I mean, you cover the whole market. When I listen to you, Jeff, over the years and read your stuff, it really does, I think, make such a case why you hire experts. In other words, fund managers. You give a nice flavor of how sophisticated your approach is, but how complicated the market is. I mean, I simply put it at the beginning: geographical, different types of real estate usage, and of course, you've done well with that. But I'm just saying, to me, I listen, I go, this is why you get a professional involved, because you like the sector and they do all the homework for you and use their expertise. Forgive me for throwing such a big question or broad question out, but you guys have done very well with REITs over the years, both sides of that, up, down, different locations. Can you give me just a quick hit on REITs?
Sure. In terms of,
well, just, are you seeing opportunities there?
Yeah, we see. I mean, I mentioned grocery anchored shopping centers.
Yeah.
Our largest holding in the fund today is the units here in Canada, First Capital REIT. It's trading around $17. Net asset value, depending on who you talk to, is between $22 and $24. A share, a unit. So 25 to 30% discount to the value of the real estate. Close to $4 billion market cap, and you're getting a 5% dividend yield. We also like Primaris REIT. Different. It's more malls, some of the fashion exposure. But today, you're buying into Primaris at a 9% cap rate, a 9% unlevered return, trading at a 26% discount to the value of the real estate and getting a 6% distribution yield. So that's one area, as I mentioned, we like. I mentioned manufactured housing communities. So we own Sun Communities, which is a $16 billion New York Stock Exchange listed REIT. This sector, because of the attractiveness that I mentioned at the outset, typically trades at a big premium to the net asset value. Between 2011 and 2021, traded at 24% premium to net asset value. You can buy into Sun today at a 10% discount. There's some activism there. You're going to see transition there. I mean, we mentioned Blackstone. 6 weeks ago, Blackstone spent $6 billion to buy the marina business from Sun Communities and allow Sun to go back to being a pure play manufacturing housing community and RV park enterprise. Data centers, I mean, from the biggest to the smallest, I mean, we have we have ownership in Equinix, which some of your audience, it's an $85 billion market cap. You can buy into Equinix today, a leader in this space globally, at a 20% discount to our view of value. And a nice sort of smaller cap name, we have something called Digital Core, which is listed in the Singapore Stock Exchange. But their properties are in Toronto and Frankfurt and Tokyo and the United States. You're getting almost a 7% dividend yield and a 22% discount to value in data centers. And finally, I mentioned seniors housing. We like Sienna Living, Senior Living, listed on TSX, SIA, it's a symbol. Yield 5.4%, $1.6 billion market cap, trading at a discount to net asset value. So those are some of it. We also like industrial on the long side of our pair, Dream Industrial. This is trading at a 40% discount to net asset value. At $10, you're getting a close to 7% yield on a $3 billion market cap, small bay industrial in Canada, mostly Toronto, Montreal, and a little bit out west in Calgary and Edmonton, Alberta. I mean, wow. I mean, 40% discount for some of the best located industrial properties, certainly in Canada, if not globally. In fact, Prologis, which is the big name in REITs generally, never mind industrial, labeled Toronto as the best industrial market they see globally.
Wow. But there's a great example of the approach you take. I mean, first of all, you have to do the research, then you do the evaluation, and then you can get a dividend kicker. And I love, digital core, because I
Yeah.
would never know about digital core. I mean, it's in Singapore, even though, as you say, the properties are, in North America and Canada, but I would never have heard of it. But, you get a nice discount, well, a significant discount, I should put it that way. And then you get a dividend yield of 6.7, nearly 7%. It's no wonder.
No, we love it. I don't think our trader loves it when he has to get up at 2 a.m. to trade the stock, but um, it's a good name. And
Yeah.
then, how do we get through these crazy days? You wake up, in March and April, and it's like, wow, this is just really. And the answer is we have to eat our own cooking. We remember, I wake up like, never mind the stock market. We own some of the best grocery anchored shopping centers in the world. We own retirement homes in some of the best locations in Canada. We have exposure to data centers with explosive growth. And then we say, wow, tariffs. Well, global international investors aren't going to want to come to the United States. Geez, we shouldn't own hotels. Wait a minute, we're short hotels. Life science in the United States, you have 30%. So there's three big pockets of life science in the United States: Cambridge, Massachusetts, San Diego, and San Francisco. The biggest by far is Cambridge. You have 30% vacancy in the market today. Another 15% of the inventory is under development with new construction with limited tenants. This is going to be ugly. So we're short.
Yeah. Yeah, fascinating. The other thing, we only touched on it, but I want to, because you've got a great track record this way, but it's part of the deal. Is what have you had? 20, 21 takeovers? Of stuff you own?
We've had 21 takeovers in our portfolio holdings in the last 16 years at an average premium of 28%.
Yeah. So, I mean, that's the value proposition, if you know what I mean. You're looking for value. You see these discounts. That's the other thing we didn't talk about. I want to also make sure people know and maybe help me with this a little bit. Of course, you've got the Vision Opportunity Fund that you launched first, and then, you've got the Vision Alternative. Is that what it's called? The Vision Alternative
Income Fund. So it's a prospectus-based version. You can buy that in as low as denomination you like. You get the same holdings, the same fees, the same redemption terms in a prospectus where your advisor can point and click and buy it on their desktop without a lot of subscription forms. And, it's just the democratization for investors through that. Regulators gave rise to providing that opportunity in 2018, and we provided that opportunity for clients starting in 2019.
Yeah, great stuff, Jeff, as usual. I know you're busy, but this has just been fascinating, and it always is. I mean, I read a ton of people, and I've been around for way too long, but we always appreciate your expertise, and I just think it puts a new perspective for a lot of people listening on the opportunities and how to play it safe. Risk averse, but value oriented, as you say. I still love it. You said you mentioned it before, but I love it. If you start in the ground, you don't have far to fall, so you can then take advantage of these declines. But as I said right up front, I know for our audience, you also made a lot of money for them playing sectors you didn't like or individual stocks you thought had got way ahead of themselves. So a big advantage for the fund. Jeff, thanks for finding time.
Nice to see you. Thanks for having me.